Hello everyone, this is Andrew McNair from SWAN Capital with our March 2022 SWAN Report. In this month's video, I want to discuss some recent headlines that influence the financial markets, but also provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, at SWAN Capital, our market outlook remains cautious because of inflation as well as the geopolitical conflicts that we're seeing. Now, Russia continues to maul its neighbor, Ukraine, and rather than roll over and fold, the Ukrainian people continue to resist, and the Russians aren't moving as quickly as they once anticipated. Now, the West has sanctioned Russia and continues to support Ukraine with military as well as humanitarian aid. Now, Ukrainian President Zelensky is not leaving. Instead, he's providing leadership and inspiration to this battered nation. These events, plus a constant drumbeat of negative news, have caused markets to bounce around at the same levels for about the past few weeks. And we got some news that seems favorable, such as soft sanctions or less than anticipated rate hikes, and the market bounces up. Then we got news of more severe sanctions, spikes in oil prices, news of an attack on a Ukrainian nuclear power plant, or a really strong jobs report strengthening the argument for higher rate increases, and down the market goes. So it's been a volatile season, which we talked about at the State of the Market that we would be expecting a volatile season. We have yet to see, though, the full fallout of the Russia-Ukraine conflict. There will not be a quick resolution, and the announced economic sanctions have yet to be fully felt on both sides. How will the world live without Russian energy? How will Russia live without pretty much everything except from what they get from China? We are a lot closer to 4,000 on the S&P 500 than we were at the record highs we saw in early January of this year. So right now we're hovering around 4,300. So far we find ourselves in a 10 to 15% correction that may present opportunities in the market. So let's turn our focus to the Federal Reserve. If there were any suspicion that the Federal Reserve might raise rates by a half a point at the conclusion of its next meeting on March 16th, Fed Chair Jerome Powell laid those fears to rest. He very clearly announced that he would give back a quarter point of 0.25% increase in the next meeting. This is highly unusual, but the clarity and the transparency and the outward dovishness of the comment was enough to boost markets on this announcement. And we've been saying that it's possible the Fed will wait too long and then move too aggressively and accelerate a decline into a recession. Now, it's becoming apparent that the Fed will do little to nothing at all. The upcoming 25 bips or 0.25% hike the Fed Chair Jerome Powell's announced will likely have no impact on an 8% inflation rate that we're currently experiencing in the economy. Anything more meaningful and aggressive will most surely push us into a recession, but it appears we're going that way anyway. It would be preferable to see the Fed use the opportunity to hike rates, stop inflation dead in its tracks, and have enough dry powder to kickstart the economy and make the recession as short and shallow as it can be. Instead, the Fed has been really mealy-mouthed and is allowing the market to drive rates and set priorities. Every time the market gets skittish, the Fed offers dovish talk that soothes them. Now, the good news for this month is the labor market's results. We got a solid January and February jobs report. Expectations were 440,000 and the actual number was 678,000. Yes, it was a strong jobs report, but it did not account for the Ukrainian invasion period. Also, the economy is decelerating. It remains to be seen how the Fed will negotiate strong data, which favors this tightening and fighting inflation, which we've already talked about, with an economy that's potentially slowing down. Wages did remain flat and hours worked ticked up last month, so workers are being asked to work more for the same money. That's not good in an 8% inflationary environment. So consumer sentiment is weakening, and a mindset is very important to the factor of whether our economy continues to grow. If people feel battered, and they do, thanks to 2 years of COVID and inflation, they will change their behavior and how they spend, and that has big consequences for the economy. That's going to be it for this month's SWAN Report, and I want to thank you for listening to our SWAN Report every month. Now remember, if you have any questions about your personal financial plan or about your portfolio and how you can be better prepared for this volatility, don't hesitate to give us a call at 850-380-9558. That's 850-380-9558. See you next month.